this, make sure you get this in here. This is the, I think it's from 3 weeks ago. And again, this one's an understatement, so we just ignore it. So this is our projected misstatement, 40,000. Basic precision. I think I'm going to cheat. Copy this. Oh. Just to get a little closer. Yeah. Okay. So basic precision is this. Boy, did I make that up? Let's shrink that down a little bit. What I did here. Oh, I got it. Okay, here we go. Okay, basic precision equals the interval times reliability factor. Okay, what's the interval?
$50,000.
Yep. So 50,000 is the interval. Times the reliability factor. And the reliability factor, let's see, this is at 5%. So I'm going to come up here. Row 0 is used for sample size and basic precision. So row 0. 5%, and the factor is 3. So we're going to multiply it by 3. $150,000. So this let's make it reddish. These are basic precision. Okay, now that the basic precision is if we didn't have any errors. If there were no errors, we would still have misstatements. So because this is a sample, it's not 100%. Our best estimate is 40,000, but it could be off by another 150,000 just because it's a sample. So with no misstatements, we would still have to have 150,000 of possible misstatement because at 5%, because it's a sample. Now, if there are errors found, it could be even more than that, and that's what we're going to do next. Okay, so let's go to the most confusing thing you'll ever see in all of accounting. Incremental allowance. And I'm kicking myself for just not going ahead and making a table for this. Incremental allowance is if you find an error, so we have two of them here, right? We have two errors here. We have our two misstatements, 30,000, 10,000. So what we're going to do is reliability factor increments. And so the reliability factor increments, we're going to have overstatement 1 minus overstatement 0 minus 1, and that will give us the first increment. Now, I know it's very confusing, but I'll show you in a second. Okay. So here's overstatement 1. We're going to subtract overstatement at 0, the reliability factor, and then minus 1 from it. See here. So this was 375, 475, 475. Okay. So so 475 minus 3 minus 1 is 0.75. And I'll show you what we do this in a second. So that would be the first incremental. And again, I know this is confusing, but I'll show you what we do in a second. Let's go ahead and do overstatement 2 minus overstatement 1. We should do it up here. I wonder if that would be easier. Well, let's go ahead and do it, and then we'll. So overstatement 2 is 630 minus overstatement 1, which is 475. So the increment, and then minus 1. Copy this. Okay, so whatever that is. And just for yucks, I'm going to go ahead and do the third one, even though we don't need it. Let's see where we go with that. Seven, 6. Oops. We really didn't have to do this one, but we don't have a third one. But just to give you an idea of what it would be, it'd be 0.46. Okay, now an obvious question is, okay, well, now what? We got these. What do we do with them? Okay, we're going to multiply this times the misstatements. And the largest misstatements first. Okay, so going up here to the misstatements. Which one's the largest?
$30,000.
So the first one will be 30,000. So you multiply this by, oops, what am I doing here? Hmm, 22,500. I think that's right. And then we're going to take the second one, which is 10,000. Yep. Equals 5,500. We don't have a third one. This one, well, this one isn't here at all, so you don't need it. You don't really need this one. I'm just going to delete it. So we'll have the total incremental allowance. Oops. Equals 28. Oops. So 22,500 for the first one, 5,500 for the second one. So the total incremental allowance is going to be 28,000. Okay, so that's a yeah, so that's gonna look like this. So in here, this incremental allowance is gonna be another 28,000. And again, this is because there's misstatements. If there weren't any misstatements, we'd only have to have these two. But because there's misstatements, this incremental allowance is, look, if they find misstatements, that means it could be off by more. And so this will add to it. So the total amount that it could be off by would be the 40, the best estimate, the 150, which is just for sampling, and the 28, which is for any misstatements that we find. And that will tell us the total, the upper limit on misstatements. So I'm just going to copy these down. Oh, wait, what happened here? Something wrong. To do more things wrong. So these all together will be the upper limit. 218. I think it's 218. So this is what we call our upper limit on misstatements. So even though our best estimate is here, this is our best estimate. It could be off by as much as 218,000. So this is our upper limit on misstatement. And again, this incremental thing is kind of wacky. I think the next time I teach this, I'm going to go ahead and make an incremental table. I mean, there's no reason why you couldn't just make an incremental table based on those. You know, it's just this minus this one and, you know, minus one. And you could easily have an incremental table. I think I'll probably do that in the future just to. But anyway, this is the actual formula for doing that. Okay. Tell you what, why don't we go ahead and we'll work on it. I'll let you guys work on this one on your own, but I think we'll do this first part together. And for number 6, and then you know, you take a break whenever you want. We'll come back and kind of put it all back together. So let's kind of go through these up here together. Okay, what do we do with this first one?
Divided by 5,000 by the book value.
Normally I would
Ignore
say,
it.
yeah, normally I say yes. This one we're going to ignore because this one we're not supposed to be able to find. This is an understatement. So yeah, normally you would kind of do like the ratio estimation thing, but this one is an understatement. So this one we're not going to do anything with. The rejected misstatement is 0, and it's not really a misstatement at all. Oh boy, what did I do here? Let me goof this up. Hold on. And is it an incremental allowance? No, because it's not even an error really. It's not a misstatement at all. Okay, now going down to this one, this is an overstatement. So we're going to go ahead and do this one. Just like you said, we're going to divide them. Get space in here. So. Okay, so the projected value of this one is 75,000. And that would make the projected misstatement 25,000. Right, so of this 100,000 sample interval, I should say, 75,000 of it was okay. 25,000 of it was a misstatement. Now notice that there could be more things wrong in here because this only covered 20,000 of this. So there could be more things that are wrong in this interval. This will be in the incremental allowance. And now for the super tricky one. What do we do with this third one?
It's an understatement.
Yeah, this one is, well, it's gonna be an overstatement. They're overstating it. They're saying it's 108 and 95. But you'll notice something weird, and that is this. This one is larger. The value of it is larger than the interval. So, oops, that's not me. So this one, it's 100% sure this one was going to get picked because it was more than $100,000, and that's the beauty of this method, is that if there is something that's overstated, if it's overstated enough, there's a 100% chance it'll get picked if it goes more than the interval, and that's what this is. However, when you start doing the incremental allowance, that interval could not get any worse. It covers the entire interval. So there is no incremental allowance when the item itself, the book value of the item, is larger than the interval. There is no incremental allowance. That interval is as misstated as it can be. So this one, we're going to switch gears here, and we're just going to get the actual misstatement, not the projected. This is actual. Which is 108,000 minus the 95,000 and that equals 13,000. So this will be our projected misstatement. It is not going to be in the incremental allowance. And again, that's kind of weird because nothing else could go wrong in this interval. This thing covers the entire interval. So we just take the actual misstatement, and it was actually misstated by 13,000. All right, this one down here, again, the same thing we did before. Zero divided by 112,000 is 0. Projected misstatement is 100,000. By the way, for this one, sometimes the books will say, if the balance is 0, the auditor should investigate as to why it's 0. You always investigate as to why it's 0. It doesn't matter what method you're using. You always investigate why something is off. So if it's, even though they say, investigate why it's 0, that's just a regular part of audit. It's just part of your job, but you see them all stick that in there. But anyway, if it is 0, and if 0 is the correct amount that it should be, then the misstatement will be 100,000, and it'll be in the allowance. So the projected misstatement would be all those together. 138.
Could you step through like a scenario for that last one? It's just like a fraudulent entry for $12,000, and the audit value says like, hey, this doesn't exist.
Yeah, and it could be that, it could be something that they have hanging on the books that is not really there. For instance, if there's a dispute, or if something was wrong with a shipment, or they shipped the order to the wrong customer, and charged them, the 12,000, they returned it, but it's still sitting on the books. something like that. Those would be some scenarios that they'd have where really the customer doesn't own anything, but they're saying that they owe $12,000. It could be a fraudulent one that you find out that it was a fictitious sale or something like that. That's true too. It could be a fraud that they simply put on the books, hoping that you wouldn't pick that one, and that it was a fraudulent sale. It could be that also. But they're saying something along the lines of that they have it on their books and it doesn't match up with what the reality is. And again, you'll always look into those, because one of the questions would be, if it was a fraudulent sale, now it changes the audit, because then now you're okay, well, I gotta look for more of these. If there's
Right.
one, there could be more. So you would definitely look into it, no matter what method you're using. If you're using classical sampling and you ran into that, same thing. Why is it off by so much? And you will, and two, even just regular errors, you'll investigate as regular errors because you want to see why. What is
Right.
it? Is it something that's systematic? That's going on.
It's,
Okay.
yeah, my brain just gets hung up on the fact that like there's potentially let's just say it's an issue of $12,000, but the weight of it is $100,000 misstatement potentially. So it's just,
Yeah.
my brain can't wrap its head around that, like the difference in the magnitude, I guess.
Yeah, and that's part of, well, and that's probably one of the reasons why they will say look into it. Obviously, you will. But this method though is sort of like it's a ratio method, and it's you just pick one item and have it represent the entire sample, and that's just the method that it uses, and the larger the sample, the smaller the interval will be. So it also depends on on that how sure do you want to be, and you'll notice that this one is at 10%. Which means you'll have a smaller sample size. And so, yeah, if you do run across errors, they can be exaggerated. Also, you got to remember, I made this, in auditing, when you do sampling, I can tell you that it usually either goes one way or the other. And then, you go through the entire sample, you don't find anything wrong, or you find all kinds of things wrong. And that's usually, that's just the way it seems to go. But, to do a reality, to have us go through, whatever, 50, 100 items or whatever, and have them all come out to be exactly the same isn't very fun. so that's why I make it a little more exciting by making, giving you the wackiest errors. And by the way, this is exactly the format that was given on the CPA exam at least a couple of times. So it is in the realm of possibilities that you'll see something like this. But you notice that this is at the 10% level, so you're not quite as sure as the 95% level, whatever that. And you'll notice that, let's say the interval is 100,000, the book accounts receivable is 2 million. So what is that, 20 items? So they're only picking 20 items to project it over. So yeah, anything that's off is going to be magnified because of the low number of items picked.
Got it. Thank you.
Yeah, so good. See if you can calculate these second two here. You can calculate B and C, and then we'll say B back at
You're on mute.
Yeah, I'm sorry, I wasn't talking. I should have been. Yeah, so 138, and then the incremental allowance was 231. I'm sorry, basic precision was 231. 69. Okay. So that is the method. Now, this one is obviously off by quite a bit. When you think about it, it's the projected that it's off by 438,000 when the total amount is only 2 million. It's quite a big chunk. You'd think that that'd be material, most likely, but question on that? And again, this incremental allowance is kind of a wacky thing. The idea behind it is fairly, kind of common sense. That is, if there's errors, if you find any errors, that means that errors can exist, and that it's, that if that there's more a bigger likelihood that there's more errors in there. So that's the incremental allowance about. The calculations for it are a little bit quirky. But you'll notice that table too, though, this method is really supposed to be only used for when you don't think there's going to be too many errors. And I say that because you look at this table, it only goes down to 5. So that tells you that, this is generally not going to be used for something that has, say, 30 errors in it. Not sharing anymore. Yeah, I'm sorry. So this table up here, it only goes up to 5 misstatements. So this is when you doubt that there's going to be too many errors in it. Then this method works well. If you do have a lot of errors in it, then you run into a problem. And we'll come down here to number 7, the advantages and disadvantages, and just kind of go over them. By the way, this is one of those things that they do test in the multiple choice questions. A lot of times on the CPA exam, they'll have, what are the advantages of this or that type of a method? When should this method be used? Those sort of questions. Okay, advantages. The big advantage here, and this is not obvious from what we did, but a smaller sample size for populations that have a lower occurrence of misstatements. If you don't think there's going to be very many misstatements, you don't expect misstatements, then you can get usually a lot of times a lot smaller sample size, and I mean like half as much. The big, a big chunk of the expense of an audit is the testing. Probably half the dollar amounts is in the testing. So if you can reduce that, any portion of that by 1/2, well, that's a great thing. So the big thing about this method is that it reduces the sample size. Automatic stratification, we're going to talk about this in a little bit here, but not just yet. And this is that you like to look at big things rather than small things. If you have a $50 item and a $50,000 item, you probably don't even care if the $50 item is completely off, but the $50,000 item is going to get your attention. That's what you want to look at. This method automatically picks that. The higher dollar amounts are going to be more likely to be picked. And at a certain point, it's 100% sure it's going to be picked. And again, this last one, probably not obvious from what we just did, but it is generally easier to use. The disadvantage, and this is the huge one, cannot be used for understatements. And this is the very big drawback to it. Yeah, so it cannot be used for understatements. And the sample size is not easily expanded. You'll notice that this is a little bit different than classical sampling in that the sample size determines the interval. So if you change the sample size, so let's say you come up with, well, like the results we just got, they're off by quite a bit. You go, well, I want to be a little more sure, you know, of my number. I'm going to take a bigger sample. It's really hard to do that with this method. You know, why? Well, when you change the sample size, it changes the interval. It changes the items you pick. So there is a problem. So if you do run into a problem, I should say, then you have a second problem. The problem is, how do you expand the sample? A lot of times you'll switch over to the classical sampling at that point, because again, if you change that sample size, that also changes the items that you pick. So in that way, you know, you can't have some difficulty with it. Okay, classical sampling, as you may have figured out, a lot of times they are kind of just the opposite of what you see up here. Smaller sample size if they have a higher occurrence of misstatements. So if you have a lot of misstatements, you'll use this method, the classical sampling. Items with negative or zero balances, as we found out, it's fine with those. So if it's possible to have negative balance. For instance, if you're going to accounts receivable. Okay, well, what if somebody returned some stuff and you didn't, you know, for whatever reason, didn't get on the books? It's possible that there's a negative balance in the accounts receivable. In other words, it's a payable. You know, it should be reclassified. But as far as getting the overall value of the population, you probably want to leave that in there because that will tell you what the real value of the population is. So even negative numbers, it doesn't bother this thing. You know, put a negative number into, you know, the other proportional size, you don't know really what to do with it. You know, zero is one thing, but put in a negative number, you know, you don't know what that's gonna. It has difficulty with it. And I'll be honest with you, I'm not even sure what you do with it. I would guess you put it in as a zero, but I guess it depends how much it's understated. Okay, the really great thing is this. Can be used for understatements or overstatements. So classical sampling. This is the stuff we already covered, the mean per unit. Oh, my caps lock's on. It's still on. So classical sampling, you know, these ones we already covered that we're talking about here, and they can be used for understatements or overstatements. Sample size can be easily expanded. It's easy to go grab some more items and audit to a higher level. Standard deviation must be calculated to determine sample size before you can do the sample size. So this is one of those things you have to, it's kind of like the chicken and the egg thing. You're trying to see what the deviation is in the sample, but you have to have a deviation before you can even find the sample size you need to pick. So you either do a preliminary sample or maybe use it last year. All right, this is an important one too. Auditing standards do not advocate one technique as being better than the other. They are simply used in different circumstances. Back in my day, when I was going through, it was kind of probably the proportional size was really being pushed and saying, okay, this is our, you know, this is our method. This isn't like the classical sampling. Classical sampling is for, weighing chickens or something. But this is just for auditing. So, this is the method that's the best. Well, it's best in some circumstances. Low expected errors and only for overstatements. So if those two things are met, then it's probably better. But yeah, so it's not for all circumstances, obviously. All right. Any question on that? Okay, we'll start in on the next